I'm Spencer McGowan, and this is Alex Tolene. Join us this week. We are going to cover shockingly good economic news. Alex, what's your hot topic?
Warnings, dangerously overpriced.
Some things dangerously overpriced. So be sure to tune in and be sure to subscribe. Welcome to the May 25th, 2026 Advanced Report and Weekly Trading Wrap-Up. I'm Spencer McGowan. This is Alex Tolene, radiating excellence and brilliance. Two topics. First, shockingly good economic news. And then, Alex?
That's right. What's overpriced? What's bringing in the FOMO hot money?
Dangerously overpriced. And we'll make that case. It's the biggest danger for the second half. But there's another danger lurking for the second half. And we'll cover that as well. On the good news side, right? We've got 4.3% economic growth.
That's
This
amazing.
was shockingly good news at the end of the week. To put that in context, average GDP for the last 20 years, 2.1%. That's over double, right?
The last time we had a really big GDP print, I think above 6 was in the 80s. So we're heading pretty close to that.
Okay, I'm going to call them out.
Okay.
Wall Street Journal they are working overtime. They said Walmart sales were up, but there's concern from the consumers. Okay, I get that. But now we go to the next slide. This is what you got to see. But look at this spike, okay? Said, here's anemic GDP growth estimate.
Right.
Boom. They get enough data from the quarter, because we're over halfway through the quarter, and they raise it. But there's something else going on here, and this is shockingly good news too. All right. Now, if the consumer is so stretched, why is Target killing it this year?
Target's up 30% this year. When you look at the earnings growth for the S&P 500, 27.5% earnings growth. I mean, that's massive.
Sales growth 11%.
That's not bad.
Now, bad news, we could put inflation at 4%, but sales growth is 11%. I got one other thing.
What's that?
All right, so job growth, right? One way you measure it on a weekly basis is they have jobless claims.
Right.
The historic low was just below 200,000 jobless claims each week, right? Because nationwide, about 100,000 people get upset and quit, and about 100,000 people, well, they don't have a job anymore, so they go file, right?
Yeah.
Well, we're still near historic record lows. So where is the gasoline-driven inflation and recession?
It's not here.
That premise has been all over the financial media because they don't like Trump. But if you get shockingly good news, I don't care what side of the aisle you're on, if you get shockingly good news, you go with it.
You know what's interesting about this chart too? Look at the blue bars, right? That's the historical trend. That's forward, still growth. I mean, they're saying Q1 2027
There's
is
Q2, that's 20%, that's 25%.
Yeah.
That's 20%.
That's 12 and a half.
12 and a half used to be awesome.
Yeah.
And the only thing I could think of, you got deregulation, you got AI productivity.
That's right.
And that may lead to the danger subject.
Ah, yes, the hot money.
Okay, the Dow's up 6%, 50,700 for the first time in history, hit it briefly intraday, just above 50,700. That's consistent with the earnings, right?
Yeah.
And we've gotten so obsessed with headlines and the potential negative of high gasoline prices. I get that. Inflation's elevated. We're going to get to that danger before this is over. Look at the NASDAQ. So AI mania comes back with a vengeance.
That's a huge rally off the March 31st lows. I mean, that's almost 30%.
That was fast.
That was big.
17% for the year, and you're right, near 30% off the lows for the NASDAQ 100. But we've got some dangerous overpricings here.
Let's cover it.
All right, there's some lessons built in here.
All right.
This is, well, tell us what this is.
So Cerebras AI, new IPO this week, came out, traded, IPO'd at 185, traded as high as 385, back down to 276 at the end of the week. And they've never made any money. They're trading at 80 times sales, right? Worth $61 billion.
Yeah, if you round their sales up, because they're growing, I get that.
Yeah.
But you're paying $64 billion if you wrote a check for the whole company. The revenue's only $800 million a year, generously annualized.
Yeah.
And we've never made money. So people put $64 billion in this.
We used to call this beware the IPO.
Whoa, dangerous overpricing. You pointed out an energy company that came public. It's like, what, $15 billion?
Yeah.
And they don't have any revenue whatsoever?
Yeah, Fervo. FRVO.
Fervo?
Fervo.
That sounds like a fever pitch there. Fervo.
Geothermal energy creation. And so you got a lot of people coming in the game. You know, at the end of the day, you want to own companies that make money, number one. And number two, ideally, that return some form of capital back to you in the shape of a dividend.
That's good.
Yeah.
Yeah. And there's still deep value out there. One of our candidates, 12 times earnings, had a catalyst. Now it's a huge gain. And that's what we're looking for in the portfolios. And we'll get to the bond market here in a second.
Yeah, well, we're still finding them.
And you don't have to buy money-losing companies. Now, here's the problem. I got SpaceX coming up June 12th. It's big news. Anthropic is supposed to make a profit this quarter, and they're supposed to IPO.
Yep.
Right?
OpenAI.
OpenAI is going to IPO, and they're not going to make money until 2030. That's billions of dollars getting sucked out of the system or into those companies. Right? And it's going to pull some of the oxygen away from good stuff. We may get some bargains in the second half.
I'm looking forward to that.
Just from that, because here's a problem in trading. First off, you eliminate a huge part of your mistakes if you don't buy companies that are losing money.
Right.
Right? I have to relearn. Every few years I relearn that mistake. And I buy something that's losing money because it's such a good story, and then I regret it. Now, that's why we don't do that in client portfolios.
Yeah.
But we will say that the premise of great companies at a reasonable price, that still works. Now, let's continue. Whoa, this is a mediocre food chain. All
Yeah,
right?
Kava got hot, came public early 23.
All the way to 172. It's just a big, boring bowl of Mediterranean food. Right?
Yeah.
There's nothing, to me, there's nothing special. But, whoa, they took that, what's that, $29 to 172. Wow.
I think at the height it was trading over 100 times earnings.
100 times earnings, but we pointed out on the show that was $4 million per location, and they didn't even own the land.
That's right.
Right? So that was a huge valuation. Now they're 83. So you went from 172 to 83, which in investing that would be considered not good.
Well, a low of 40 after hitting 173 is that's hard to hold.
And
right?
yeah, you lose 3/4, and it's a distraction. It keeps you from looking at other stuff because you had this great trade and you overdid it. Well, this is still dangerously overpriced. So it's growing at about 20%.
Yeah.
Okay, the restaurants do make money. I'm going to price it at 20 times earnings. Is it 83?
20.
It's 20. And that's generously priced.
Yeah.
So that'd be the point that it looks kind of like a bargain. But at some point, you've got all the kavas you need because you pointed out what was one of your old favorites?
Boston chicken.
Boston chicken. Stuckey's.
Yeah.
Yeah. That's a blast from the past.
That's way back when.
Yeah, Papa Dean would be driving us along and would stop at Stuckey's and they had pralines and bad food. And so it was, anyway, Buc-ee's is the next phase.
Ooh.
Buc-ee's makes money. But, all right, now we get to a danger. This is For fixed income strategists, the world had forgotten what duration risk was when interest rates were so low for so long.
For a long time.
There's an unwinding of this with the inflation, and it may create some bargains in fixed income. Not yet, but private credit default rate 6% in April.
Yeah.
We said private credit, don't be doing that.
That's like the Hotel California. Once
Yeah.
you get in, you can't get out.
Well, yeah, I want to be the secondary market, get in there and buy stuff
them cheap.
that people are desperate to sell. But anyway, that says there could be some trouble. Look at this. All right, explain what this is, because it goes from here to here. That looks dramatic.
Yeah, that's the 30-year yield on the bonds, 30-year bond rate.
From February, Epic Fury began on the 28th. You see it right here, 5.2% on a 30-year bond. You know what some pension managers will do in the second half?
Well, they're thinking, hey,
I'll get 5% guaranteed. That's my actuarial assumption. I'm just going to move some money there.
That's right.
I'm going to take my profits on Cerebras or whatever. and so that puts a little danger on, especially on things that are overpriced. Explain duration risk.
So duration risk is how much does the price of the bond change given the rate of change of interest rates. And the longer you go out, the bigger the move generally, right? So if you look at this, when you went all the way zero in the pandemic, the bond price was almost double maturity value. That's
Wow.
a big premium. And now you're sitting at 84 cents on the dollar.
This is the low-cost 20-year Treasury exchange-traded fund.
Now you think you're in a safe place in your Treasury fund, but if you lose half the money, it's not that safe.
I think in tax loss selling, there's going to be some tax loss selling in this category.
Yeah.
And that'll put some pressure, and it may create some bargains in December for the managed accounts, the McGowan Group Wealth Management portfolios, to actually step in there and get some bargains before the end of the year. McGowan Group Wealth Management, did you have something else?
I did. So we do a weekly search on bonds that might fit our criteria, particularly in the muni and tax-free space, and we have not seen them shaken loose yet. So I think that time comes and we're ready to get them.
Well, that would shake me loose.
Well, yeah.
So not that we had that, but McGowan Group Wealth Management, managed accounts as a fiduciary, a team of 9 devoted to your success, coordinating estate planning, tax planning, and of course an upgraded financial plan for 2026. You can just go to networthradio.com or themcgowangroup.com. Contact us there, and we look forward to serving you and your family in the decades ahead. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.